The biggest mistake I see founders make is setting expectations that are higher than where the company is. So the biggest blind spot in companies and the easiest place to burn a lot of capital with minimal results is product. Nobody is more focused on your customers than your CEO. We've seen a ton of companies increase from nothing to 5-10 million in ARR in 6 months. Companies that are wrappers on top of LLM, they're seeing really low gross margin. Seed and growth equity, for the most part, are going to be minority investors. And there are seed investors that write $15 million checks, right? So we're typically writing checks in businesses that have strong growth.
Capital efficient growth is having a moment. And today we're breaking down what it really makes a company fundable and what silently kills deals behind the scenes. We'll dig into board level patterns, AI era product moats, and the realities of choosing the right investors while scaling responsibly. Joining us is an expert in this field, Melanie Nabar, Vice President at Volition Capital, bringing deep expertise across growth stage investing and founder partnerships. Welcome, Melanie. Thank you so much for being here.
Thank you for having me. I'm excited for the conversation. A lot of topics to cover here.
Oh yeah, lots, a lot of broad topics. Let's talk a little bit about what makes companies truly fundable, because this is a conversation you and I had. When you evaluate a Series A or Series B company, what are the first indicators that signal it's truly fundable?
Yeah, no, it's a great question. I think as I assess businesses in the Series A specifically, I'm looking for a big problem. I'm looking for a company that's playing in a market that is growing. You know, rising tides lift all boats. It's a corny phrase, but it is also true. So, first, we're looking for strong growth markets. The second thing we're looking for is some strong traction. So, Series A, typically the risk profile of investors is slightly lower in terms of, hey, we need to feel like there are real customers that are buying the product. There's some semblance of repeatability in a sales motion, whether it's founder-led sales or from a sales team. There's clearly adoption in the market. We're also looking for some indicators that those customers are going to stick around. So that could be in the age of AI, where usage versus SaaS is seeing the win. It could be, strong cohort growth. Somebody signs on and they keep using more and more. It could be that it's a true SaaS model and folks have come up for renewal and continued to buy more. And then the biggest thing we look for is the founder dynamics. I'd say, most Series A companies that don't make it, it's still typically founder driven. These are early companies. There's a lot of wood to chop, a lot of scaling to do, and founder dynamics play a really big role in the outcomes of these companies.
Is it necessary that they, by now, for the Series A, that they've found their product market fit, or are you still in on the journey if they haven't yet?
Yeah, it's a great question. I think it depends on the type of investor you're partnering with. So there are Series A investors that are much more VC in style, meaning that they'll invest in a higher number of companies within their given fund. And so they're playing the power law. You need, one or two companies to see breakout growth, and the rest, if they don't succeed, it's okay because they're going to be made up for by those one or two. And then there are more growth equity focused Series A investors. That's a Volition Capital. That's what we do. And for these companies, we typically want to feel like there is product market fit. And what we are good at is helping to take that product market fit and scale it up.
Sure.
And I think that also comes across in the number of companies we invest in. So we're investing in a smaller number of companies, so we need to feel like each one of them will succeed, or we can help them succeed. And we're playing in the power law game a little bit less. And so it's a risk question and a bit of a non-answer, because it does depend on the Series A investor you're speaking with.
What components of fundability do founders overlook that end up being critical, and it could cost them the investment?
Yeah, it's a great question. I think as you think about fundability, investors are really focused on the vision. And I think sometimes founders focus almost too much on the numbers and the history, while as in when we're coming in, we're focused on what's going to happen. So
Hmm.
a lot of our conversations with founders, there's usually a deck that they'll present in a first meeting. It's not necessary, but a lot of founders will have prepared one. And the first slide is usually this is our product. And the second slide is this is our financials. And I think one thing people miss is the real question is like, what is the market problem you're solving? And if you can get investors to buy into this gap in the market that your product is filling, yes, the financials matter, but these companies in Series A are still so early that there's a lot you can do and usually many levers you can pull to create a successful outcome if you can buy into that market problem.
Melanie, you talked about valuations. How serious do you all take, valuations? Because at the seed pre-seed round, everybody thinks they're worth $8 to $20 million, right? God forbid they're a Y Combinator company, they're automatically 20 million. And sometimes we obsess over that. Sometimes we like whatever, it's fine. It doesn't matter if they're going to make it; they're going to make it well past this.
Right.
Like, how much do you all focus on the valuation?
Yeah, it depends a bit on how big the company is. So for Volition, we are typically coming in when folks are north of, say, 4 million in ARR. So these are Series A, could be early Series B companies as well. And with that, you start to focus on valuation. A company that's a million in ARR, what's it worth? It's so early, who knows? But when a company gets to be 10, 15 million in ARR, you are considering valuation. You're considering what's our entry multiple? How fast is the company going to grow in order to get the returns that we've promised our LPs? So I would say Series A, you do start to think about valuation as a consideration.
And what are some typical multiples at that point? So typically, when someone is at a million ARR, they think they're worth 20 million, which is kind of the given.
Yeah.
You're mentioning at that point, there's a lot of play. How about at 10 million? Are they automatically worth 20 times ARR, or how do you all decide that?
You're gonna get me into trouble.
I
Somebody's gonna come
know.
back and say, you said that you'd value me at XYZ. I kid. I'd say it depends on a lot of factors. So again, a bit of a non-answer, but I'll tell you the factors that we think about. The first is growth. So if something, an asset, a company is growing fast enough and you feel like there is good visibility to continue that growth, you're of course going to pay a higher multiple because theoretically a year from now you feel really good about the price you pay, even though at the time of investment it may seem like a steep valuation. And that's partially why you're seeing these AI companies raise at 20x, back to what feels like a 2021 era where everybody thought they were worth 20x. It's really from the growth. So you could be an AI company, but if you're growing 50% versus 200%, you're not going to see that 20x multiple. The other thing I would think about is revenue quality. So that
Mm,
means churn. How much does it cost for you to acquire customers? The market size will play a part, right? Because you can only own a certain portion of the market, and that defines how big you could potentially become. All of those come together to play into valuation. And I'd say we're seeing everything from companies that are trading at 5x to companies that are trading at 25x, and it really does depend. So it's a broad range. And I think as you think about your own startup, if you're listening and you're thinking about valuation, I'd say focus on growth, focus on how big your market is, and focus on what your revenue quality is to give yourself a sanity check of, hey, what might I be worth today?
sure. Revenue quality, a very interesting concept. What is a quality revenue versus less quality revenue?
Yeah, good question. So, revenue quality, I'd say there's a few factors. The first is repeatability. So, if you're making a one time sale, maybe I'm selling you a car, that's lower revenue quality because it's not going to come around next year. Next year, I have to find four more of you to sell cars to in order to 4x my business. If I am a repeatable revenue company where every year my customers renew at 100% or maybe even above 100%, that revenue quality is much higher because to double, I just have to add the same amount I added this year, next year, because my revenue next year is going to come in just like it did this year.
Sure.
And so that's higher revenue quality. Another piece of revenue quality is your margins, right? So if it costs me 70% of my revenue to service customers, that's going to be lower quality revenue.
Okay.
And so you always have to think about your contribution profit in addition to the repeatability of that revenue. And the more repeatable, the higher margin, the higher valuation the companies will see.
Sure. Not only one off the line kind of question. I noticed when I talk to VCs that their vintage year was 2021. They tend to have the IRR is so much less, or the growth is so much less because I guess it was such a bad year.
Mm-hmm.
And now we're seeing an uptick in 23, 24. Are you seeing more investments? Are you seeing more excitement in the marketplace? Or is it that the valuations were so humbled from 21 and 22 that VCs kind of now dictate valuations a little bit? They took back control a little bit and are now able to get better values. So it absolutely made sense to invest versus 21. It was like, whatever, man. Like, this doesn't make any sense anymore, right? What are you seeing in the marketplace?
Yeah, no, you're right. 2021 for most investment funds is a tougher vintage because in 2021 we saw crazy multiples. I don't know how many deals I lost because people were willing to pay 25x for an okay looking company where I'm like, oh man, like in 2 years we could see half that valuation. We might even be seeing a fourth of the valuation. So one of the reasons those vintages are struggling is what you're talking about. It was a hype market. Candidly, Volition didn't do a lot of investing in 2021. And at the time it felt like, oh, are we missing something? But I think that the reality is we said, this doesn't make sense. And it played out in our favor this time around. The other piece of it is in 2021, I'd say people lost sight of capital efficiency. So it was growth at all costs. Companies were raising a ton of debt because cash was free, right? Why not raise a bunch of debt at 2% interest all day long? And what's happening to those companies that raised a bunch of debt during times when it was easy to raise debt and interest rates are low is those balloon payments are coming to terms and they're not able to renegotiate debt that they had before at all, or even at the interest rates that would make the business model feasible. So companies that folks are investing in now, all of a sudden, we were always capital efficient, but maybe we sounded crazy at a point in the market. Now capital efficient is a priority. So people are thinking about, you raised 10 million. What did you do with it? Were you able to create 10 million of ARR from that? That's a pretty good ratio. Or did you burn 20 million to get to 3 million in ARR? Well, that could be risky in the future if we're seeing similar levels, because in order to grow, all of a sudden we'll need 40 million to double and suddenly we have an upside down cap table. So I think the companies folks are investing in are also stronger business models. And whether that's because founders are focusing on, the fundamentals more, or investors are not leading them astray by trying to push them to burn at all costs, likely a little bit of both, but I think both factors are at play.
Huge. Sometimes, a couple takeaways from what you said is sometimes it's best to do nothing, right? Because you all kind of did nothing, and whether it was strategic or you were just being disciplined to your kind of your thesis or whatever you want to call it, where you said, no, this doesn't make sense, we're gonna pass. And sometimes it's that, and then what's the old saying, right? When others are being greedy, run. When others are scared, go all in. I don't know the actual saying, but it'll come to me later. That's huge. I noticed that people were in a hype market. I don't want to miss out, right? I don't want to miss out, so I'm gonna, startups were giving people 2-3 days to make a decision. You were lucky to invest. Oh my God, thank you. How am I supposed to do due diligence in a week, right? So, and I think that changed in 23, 24, and I think that was really healthy for the market. And now people are a lot more reasonable. And I think AI has created so much noise that now anyone can do a startup. And most of their startups will be gone with the next release of whatever AI, LLM agent that's going to come out. So it's good to know too.
You said something interesting that resonates with how we invest here at Volition. You said, when others are running away, that's when you should double down. And I think as a firm, we really focus on trying to be contrarian investors. So find a great company that's growing nicely, but has one piece of hair that everybody else is scared of. Maybe it's a sector that folks saw poor returns on in their last funds and are completely not focused on now. Let's invest in those areas because chances are, if you fast forward 5 years, all of a sudden XYZ is back in vogue and suddenly you look smart for focusing where others were running away from before.
That's huge. What are the most common deal killing mistakes you see founders make without realizing it? Like, think from a founder perspective. What's costing them deals?
Yeah, great question. It relates back a little to what you were talking about, where founders were giving 2 to 3 days during, the hype market for investors to make a decision. And I think the biggest mistake I see founders make is producing or setting expectations that are higher than where the company is. So more often than not, I'll talk to founders and they'll share their numbers. They'll share, hey, we're growing 100% year over year. Let's say we're going to end the year at 10 million in ARR and, we're bootstrapped. Wow, what a company. That's a great story. I will invest in that business all day long. And then we'll get information. Ultimately, you're always going to have to share information. Maybe it's revenue by customer or your income statement. We're not going to do a Series A investment without real details, and the information won't match. And the problem with that is twofold. One, we've wasted your time. If it's outside of what we're willing to invest in, then you just spent time pulling together information. Maybe there was a specific analysis we asked for. We're wasting the founder's time. The other thing is it could actually be still quite a solid business. Maybe it's 10 million in ARR growing 50% in bootstrapped. That's still an awesome company. But because you've set expectations at, 100% growth, there's a level of trust that's lost. And there's a level of confidence in the founders that they have a full understanding of their business and their numbers and where they are from a progress perspective that also loses confidence. The other aspect this could add, if you ask for bids in 2 to 3 days, like we once did in 2021, is you could set an expectation on valuation that the investors can't actually honor once you get under the hood. And that is wasting founders' time even more. It is also hurting the relationship between founders and the investors, because founders feel like the investors are reneging, and investors feel like the founder maybe doesn't actually understand how quickly their business is growing. So that can create issues from trust, valuation, time wasted. And it is interesting that it happens as much as it does, because as a founder, man, time is your most precious asset. You don't want to spend any time talking to investors that are not going to be the right fit for you. So sure, if you can screen them faster, I guess if I were to go into the founder's seat, I would want to do that as much as possible.
This reminds me, this kind of overhyping your own business. It reminds me of when we hire someone high level enough, they have to do a 30, 60, 365 plan for us. They have to show us what they expect they can do, including numbers. And it's funny that people don't think in a year or in 90 days, I'm going to look at that and say, hey, right, you said you could do this and you haven't even come close. Even though we took your numbers, lowered it because we thought that was great that you're going for it, but we don't believe it. People forget they're going to have to come back and produce those numbers they talked about. And now you said 100%, you're growing at 42, and we're not happy because, like you said, the credibility lost, this we can't trust this person's expectations anymore, their budgeting, so on and so forth. So that's another thing people don't think about, because they're just like, oh my God, when I get this money, the world is ours. Not necessarily, you know. Melanie, speaking of money, what do you all expect people to spend money on? Because again, the numbers are rising. I'm seeing $10-20 million seeds again. I'm like, what? $10 million seed and $80 million Series A. What are they doing with this money? What do you expect? What do you all expect them to do, and what are they actually doing with this money?
It's interesting because yes, there are still those, $20 million seed rounds floating around, but I actually feel like it takes less than ever to build a startup because of AI and productivity tools that are available. I'd say when we invest, there's a few places we want to see it, folks spending. First is product, because you need to stay ahead of the market. If you're a vertical focused company, you need to be building cross-sell products to continually expand your TAM. Product is important. For the most part, though, when we come in, product market fit is somewhat established. The product is there. What's usually missing is the go-to-market motion. Most of the companies I invest in are still founder-led sales when we come in, or maybe there's one sales rep that is producing the vast majority of new sales. Eventually, no matter how good that one sales rep is, eventually you need to build a sales team. And that typically takes some capital and experimentation. That is one advantage of raising capital, is you have money to experiment a little. Hey, let's sprinkle a few $100,000 here, a few $100,000 there, and then double down on whatever's working. So sales and marketing ends up being a big piece of the puzzle. We are also seeing more founders think about secondary in their Series A, which I think is a smart and interesting trend. It's smart because if you're a founder and a first-time founder, which, most founders out there are first-time founders, you have most of your net worth tied up into your business. And when you have all of your net worth in one asset, you're going to think about it differently. You might be a little bit more risk averse with that asset, especially once you start to get to a place where it's worth 30 to 100 million, right? That's a lot of money. And so folks are thinking about taking some secondary to de-risk their own personal balance sheet, which enables them to, hey, if you have $5 million in the bank, you're not worrying about your kids' college. You're not worrying about paying your mortgage. That's for sure. Like, all of those life necessities are taken care of. And so the way that you think about your business can shift. And we're seeing more folks actually raise that, what we call secondary. So basically taking some chips off the table in that Series A. And it is also helping founders to bridge the gap in check size between investors' wants, which, hey, maybe I want to put $25 million to work, and what the business needs. Maybe the business only needs $15 million because it's quite efficient and it's built out AI productivity tools. And together, that secondary and the primary capital can make everybody happy, de-risk the founder, and also enable investors to put the right amount of money to work in each asset.
Interesting. So the VC is not going to be necessarily against the founder saying, hey, I want to take some chips off the table. I want to actually enjoy some of this, and I want to put money aside to take care of my family. That's not looked at as, oh man, this guy's a lifestyle guy, or, she just wants to take it easy.
I don't think so. At least VC, as the way I think about VC, is earlier stage, but growth equity, a Series A, a Series B, I don't view that as a problem, especially when the founder still owns, 75% of the business. Like, they're not riding off into the sunset with $5 million or $10 million when they have this asset that they own majority of.
Got it. What do you see founders burning too much money on, too much capital on, and vice versa? How do you see the opposite happening, where companies are raising money and sitting on it and they're not stepping on it? How do you all deal with that, right? Where are you involved in those and saying, hey, come on, guys, you raised $10 million. We gotta step on it a little bit. You're not using your money, and vice versa. Hey, your burn rate is very fast. Like, slow down. Like, tell me about how you deal with that.
Yeah. I think the biggest blind spot in companies and the easiest place to burn a lot of capital with minimal results is product. Sales and marketing, you can measure efficiency all day long. We can say, oh, your LTV CAC ratio is going off the rails, your CAC payback is increasing like crazy. That can be measured, and we can see how sales reps are producing. We can see the marketing funnel. It's very measured. Meanwhile, product, who knows, right? When we get to a board meeting and we go through product, for the most part, it's, hey, here's our product roadmap, but there aren't that many metrics that we're looking at outside of the total R&D spend. And it can be a place that if founders and tech leaders are not focused on what is really adding value for customers, what is really driving increased spend with customers or retention, if they're not focused on that, you can spend a lot of money in tech without really catching yourself in
They're
time.
like trying to perfect. I noticed early stage startups that I invested in, a few of them I advised, I noticed they were trying to perfect a product, but their go to market was really weak. And
Right.
it's like you're perfecting a product no one's ever going to see.
Yeah.
Like you got to spend some money on go to market, man. You got to, systemize that. You got to go to market. You got to, then you hear, oh yeah, we're running out of money and we don't know what to do. It's like,
Yeah.
yeah, how about trying to sell your product? Got
And
it.
I
So
think
R&D,
it all comes back to, like, nobody is more focused on your customers than your CEO. So if you're CEO of a company, you're a founder of a company, and you're not talking to customers all the time and asking them if they want this product and asking them for feedback on your product and asking them, hey, how was the sales process and what did you think of the experience? Then nobody's thinking about it. And you can fall into that trap of you're too product focused. Or flip side is you're trying to sell a product everybody hates. And maybe you're spending enough money that some people are buying it, but it's going to bite you on the other end when people come up for renewal and you're not spending enough in product. But it all, at the end of the day, is, are you focused on your customers and are you producing what people actually want and need? It sounds so simple, but it is a lot harder than it
for
sounds.
sure, for sure. And how about the opposite? Because you talked about potentially burning too much capital on R&D without really knowing the ROI. I guess. How about the opposite when they're just sitting on it?
Yes, yeah, that's right. So that happens a lot in companies that have historically been bootstrapped. So when we invest in a company that's made it to, say, 10 million, 15 million in ARR without raising a penny, which is incredible, there tends to be a hesitation to spend money, right? And typically where they're not investing is in sales and marketing. If I see somebody with unit economics of 9 times LTV to the cost of customer acquisition, like, you're not spending enough in sales and marketing, right? So it tends to be that the process is working, the sales reps are working, but we're not investing enough in marketing in order to produce enough leads to support new sales reps. And bootstrap founders tend to think marketing is a, swear word for the
Yeah,
most
we
part.
don't need it. We don't need it.
Yes. And eventually you do need marketing, you need lead gen in order to fill the funnel, in order to hire enough sales reps to keep growing and keep increasing your new sales every year. It's going to get harder and harder to grow the bigger you are. And at some point, that funnel needs to start working.
That's great. And how should founders think more strategically about hiring, whether it's tech people, sales team, versus throwing bodies at the problem? And again, opposite, contrarian. You're a contrarian. I like that. And at the same time, it's like you have all this money, man, but you're not hiring anybody. Like you need people. Stop relying so much on AI. Like it's still a people business. We still have to, and all that. So, what are your thoughts on that?
It's a good question. I think the more you can use AI to create efficiency in the people in your organization, the better. Where that won't work is where it is a people problem, i.e., customer relationships. I think that there's a lot of value in having CSMs, customer support managers who have really strong relationships with customers, especially if you're an enterprise organization where you're selling to enterprises. You can save yourself a lot of grief by building good personal relationships there where you can get the benefit of the doubt if your product does hit a roadblock or a blip. And that's one area I think companies still need to invest in people. R&D is an area that I think there's a ton of opportunity to leverage AI to increase productivity, but you still do need folks who have the experience to monitor that what you're putting out in the world, what your code base is comprised of, is still best in class and differentiated. And I think the product road mapping and building your product to match what customers really need, that is still a soft skill that is going to require people. There isn't a one size fits all answer for it. I think right now people are still just dipping their toe in the water of gaining efficiencies from AI. And in the meantime, people are still the answer to solving problems in a short term fashion. But the scale that folks will see, the operating leverage, should see magnitudes greater as companies get larger and larger.
Melanie, just to double down on what you said, the biggest decision for us when we work with a software vendor or a new product, whatever it is the experience, the customer experience. Because we have a CTO and a CPO now, and the first things is, hey, I want to work with your APIs. I want to talk to your CTO. Any company that's like, oh no, we don't do that. Sign up here, it's free. Then good luck. We dispose of those tools. I mean, we'll try them, and if it's not perfect, then we're done, because we know there is no opportunity to improve, to adjust, to change, to impact. So we don't deal with those products, and I don't care how good or bad it is. It's just not something we're interested in, because we want a partnership. So any company that doesn't give us that exposure and that opportunity to have a customer success person, to have a kind of a champion for us, we say no. I don't care how big the product is. It's just not worth it for us. So you nailed it. I think people forget that. And tech people often forget that, because they just want to be left alone. And, I don't need that. So they think the customers don't need that. They absolutely need that. They want that. They crave that.
Even really product-led growth businesses, which should subscribe to the, hey, let's sign up and you're off to the races.
Sure.
It still needs to be centered on that customer experience, to your point, because otherwise folks go through that funnel and they have this exact reaction that you're describing. You don't feel like it fully follows your problem, your needs. And as a result, because you can't work with any person to solve it, you're out. And so the connection to customers and customer experience is just as important in a product-led growth business as is in an enterprise, but the way you interact might be different. If you're product-led growth focused on SMBs, you can't have a phone call every day with all your customers, but you need some feedback mechanism. You need your CEO really focused on that customer experience still.
Agreed. Let's talk a little bit about building product moats in an age of AI, which is very, very difficult, right? How do you determine whether a company leveraging AI actually has a defensible moat?
It's a great question. It is the number one question on every company that we talk to right now. It's, hey, how do you stay ahead? Because what you're able to do is so incredible with what is available through AI. I think about it in a few different areas. One is integration. So I think if you are fully integrated into workflows, into all the systems that are used, that does create a moat, because that takes time, it takes effort, it takes partnership relationships that maybe you can even get legal exclusivity on. That creates a moat. The other area that creates a moat more and more now is around community and brand. These sound like fluffy words. They come back to what we were talking about before, where you need to be providing such a great customer experience that you are creating fans. And you have fans, and those fans are loyal. And as a result, you have a really strong brand. That's going to win out over an identical product all day. And so I think brand is actually becoming more important than ever. And as we think about moats, first mover advantage is becoming more important than ever. But if you're not taking that first mover advantage and building an avid community and fan base and brand, then
So
you will
worth
be
it.
replaced because somebody will catch up with you from an R&D perspective.
Interesting. Why is workflow integration such a critical differentiator for AI companies today?
Yeah, it comes down to how easy it is to rip and replace the solution. So the more that you are a system of record or you are incorporated into multiple touch points in an organization, either from a tech stack perspective or even from a functional perspective, the harder it is to pull those behaviors out, pull that system out, and replace it with something that's maybe slightly better, slightly cheaper, and ultimately will become a commodity over time. And so that is where the importance comes in. I also think that if you are integrated into the workflow, you haven't just built a tool, you've built something that is becoming a piece of how people work. And the hardest thing to change is behaviors and habits. And so if you can become part of the habits in somebody's workday, I think that creates a lot of defensibility.
It goes back to like need versus want,
Yes.
right? Want cool tools, this and that.
Yeah.
Need this, or I get really frustrated because I need it. Where is it,
Yeah.
right? It's like our
Yeah.
coffee. What do you and
Definitely in the need bucket.
right? Let's talk about the moat piece. We talked about it a little bit, but what separates an AI company that can actually scale versus the one that's primarily hype driven? Because again, the first iteration of AI couple years ago was basically wrappers, right?
Yeah.
Built on somebody else's model. Like what are you looking at when you're making a decision? I look at, hey, can this be replaced in 6 months to a year with the next release?
Yeah.
What else should we be looking at
Yeah.
to see if this is a scalable AI product, with some form of a moat versus just hype?
Good question. There are actually investment firms out there that have hired a bunch of developers and they say, if I can build this product for the most part 90% there during diligence, like, then you're not going to go through the investment.
Wow.
So that is a factor. How quickly can this be built? How easy is this to build? The other piece that's, I think, for us is an indicator is churn. We've seen ton of companies increase from nothing to 5-10 million in ARR in 6 months. But when you get under the hood and you look at how new customers behave 2 months in, 3 months in, there's not that much longitudinal data, but you can see a few months, we're seeing really high churn rates. And this kind of follows the typical adoption cycle, right? People are experimenting. And the difference between like a hype AI company and a true platform, from my perspective, is, are people experimenting or are you becoming a part of that habit and that workflow? And you're going to be able to see that in quick behaviors from retention perspective and a usage perspective. The other indicator from a numbers lens is gross margin. So companies that are wrappers on top of LLMs, where there isn't a lot of value add on top of the model outside of, the high level UI wrapper, they're seeing really low gross margins. They're not seeing the 70% plus SaaS type gross margins. They're seeing 20% gross margins because they're not able to charge enough on top of the costs of the LLM because they haven't really built that much on top of it, right? And so that's an indicator that we've been looking for as we're trying to navigate this world where it used to be a 10 million ARR business had history, it had, patterns of go-to-market adoption and sales efficiency, and now it's 3 months of data. Do you think that this is a durable business or not? Which is definitely a new arena for Series A, Series B investors.
I mean, from a seed perspective, we're getting pitched $15 million valuation companies without an MVP.
Yeah.
It's really like, I'm like, what are we investing in? This idea? It's crazy. Really, really tough. And those people hopefully are getting the right feedback and going back to the drawing board. Let's switch the conversation from, what the VCs want, this and that, but let's talk about how founders, what questions should they be asking before taking capital or even pitching? Because you brought that up. Don't waste your time pitching to VCs that you're not part of their thesis or your numbers won't make sense during due diligence. What's your thoughts on that? What questions should they be asking?
Yes. It is something that is overlooked. Often founders allow investors to do quite a bit of diligence, of course, on their business before coming in as partners, but it's a long-term relationship. Once somebody is on your cap table, they're on there until you recap or sell, which could be 10 years down the line or more. And so doing diligence on the investors you're thinking about working with is just as important. It is astounding to me how few times in new founders ask to actually speak to companies that we work with. So we actually always force, folks we're thinking about investing in to talk with our existing portfolio companies, both talk to the good companies that are crushing it, but also talk to the ones that are hitting some bumps in the road. How are these investors going to behave when things don't go right? Because they're not going to go right every single year, every single quarter, et cetera. And so I think the first thing people should ask as founders diligencing investors is ask to talk to folks who are already working with the partners and other investment team members that you will be working with on your board. So that's rule number one. The other areas that people don't typically focus on is information about the fund itself. It can impact the psychology of people on your board. So, for example, a first-time fund, a fund that is new and it is deploying capital for the first time. If you're a part of a first-time fund, your investors are always going to push you to raise capital sooner rather than later because they want a markup. They want to be able to say that they invested in this company at whatever, 25 million, and it's now 50 million. So wow, look at that. We doubled our valuation in these companies in a year. So our funds are going to be amazing. We go out to raise our fund two, everybody's going to want to invest. Sure. So that's a psychology principle. If you're fund two, investors in those funds, so the limited partners that are giving investors money, they're going to be starting to think about actually, did they distribute capital back to me or did they just write all these assets up? So if you're in fund two of a new investment firm, you're going to be pushed to exit faster than if you were in a fund that is in fund six and has an established base of LPs who have seen these investors perform over and over again, so are going to give more patience to the exit, right? And so these are psychology questions that never come up. Nobody really thinks about it from that perspective. I think they do think about, oh, are you an established firm because I want to partner with a top growth equity firm, which is fair, but they're not thinking about the psychology of who is on your board and how and why they might be pushing for different things. Nobody ever asks me like, hey, the fund that you're investing in me from, like, how is it performing? Like, did you have an exit early on in that fund? Because if you did, your LPs are going to be more patient. So you're going to be okay investing in me and I want to build this business for 15 years and you're going to let me do it because your LPs are going to be okay with it because you've already given them some capital back. Or are you a kick save investment? Are you the last investment in a terrible fund where they've just made terrible investments in that fund? So you need to save it, right? Which means you're going to be pushed to do things from an upside perspective that may create downside risk that as a founder, you're actually not willing to take. And so there's a lot of psychology in investors. And at the end of the day, investors have two sets of customers, right? I have two sets of customers. I have my portfolio companies and I have my limited partners. And you need to be thinking about the psychology as a founder of the other side of the coin, right?
That's really interesting. You're right. This is not something you would think as a startup that you can even ask. So thank you for that, Melanie. Yeah, that's really powerful stuff because I, as an investor, I'm barely asking those questions, to be honest with you, right? But I'm looking at it. I'm like, okay, your fund one has a 40% IRR. You think you can produce 40% IRR? Wait a minute. Your first fund was $5 million, $10 million. You're writing tiny checks of very, early stage startups, and a couple of them rocked it. But just, now they're raising their Series A. But can you do it again? Probably not, right? So I look at that, but all this stuff you talked about, it's huge. So they're looking at you as the savior. We got to get the fund back. It's all you, right? You got to pay. We need 100x return for us to return the fund and look successful for the next raise. That's really interesting.
Yeah.
Should they care about the size of the fund? The actual value is 10 million versus 100 million. Do they care?
You should care as a founder as it relates to what percentage the check that went into your business is of the total fund. So if you are a $10 million check in a $10 billion fund, it doesn't really matter how you perform. Unless you are going to be 100xer, it doesn't move the needle. So
it's opposite in this case. It's opposite. You don't matter as much. There's not enough support, I'm guessing. Sorry to
not
interrupt.
enough support. So it'll impact your support. So if you are, a $50 million check in a $500 million fund, you're going to get a lot of attention because you are very important to the returns. And so you're going to get all the resources, and that will impact your experience with your investors. And so it has to do with how big is the fund, how big is the check, how concentrated is the fund. If a fund is only doing 20 investments versus 50, you're probably going to get more attention, even if you are a smaller check in that fund.
Interesting.
And so these are important levers. Now, if you're a $250 million check in a $1 billion fund, like, you're going to get a lot of attention too. So it just slides on the scale in terms of check size and fund size as you consider how much support and attention you'll get as a portfolio company.
It almost feels like you're the solo child of a couple versus the 13th.
Yeah.
On one, so much pressure. You must be a doctor. You must be amazing. And the other one's like, look, I don't know, man. Just figure it out. Go ask your siblings.
Yeah.
Whatever.
Once you get to kid number 6, it's like, no.
It's all downhill.
I will say the number of kids in a fund is larger, like 15 to 20 companies in a fund is a pretty concentrated fund. I don't think I could handle 15 to 20 children though. That's too much.
Yeah, it's a lot. Should the startup care as much about your thesis as you do as a VC? Like, should they care? I mean, at the end of the day, yes, of course, there's reasons why I want to know, all the other companies in your portfolio and your expertise and all that. But right now, I just need $10 million so I can scale my company. How much should I, as the founder, really care about your thesis?
It's a good question. It's helpful when a founder is working with an investor that has some sort of a thesis, just because it speeds along diligence if they have some understanding of the industry versus, having to educate from ground zero. And it can be helpful on the board level if you have experience in a different sector or a business model that relates. That can be helpful because there's pattern recognition. So that is definitely important. I think as it relates to drilling down to like a specific thesis, like, what is your thesis in, compliance, technology, in manufacturing? Well, to me, I think investors at a Series A perspective, it's less about introductions. It's less about, can you introduce me to the 10 biggest manufacturers? Seed stage, it matters if you can make those introductions. Series A, to me, starts to go into, can you help me scale, right? Mm-hmm. It's great if you can introduce me to 1 or 2 folks, but I really need to meet 100 folks, right? I need to meet 100 prospective customers. And so you're not going to be able to introduce me to enough to really, fill that bucket. And so forget about that. Let's focus on the pattern recognition. To that end, pattern recognition in different industries can be helpful, as I mentioned, but it's a little bit less important, I think, the drilled down thesis as it is in seed once you get to kind of Series A, Series B.
That's really good. What was your biggest aha moment or an epiphany in your investing career so far?
It is not always up and to the right like it looks when you're seeing it from a retrospective view. I think, as I made my first investments, where you start to get measured once you get to a certain level as an investor, right? When you're straight out of college or a few years in, you're kind of just working hard and trying to figure out what's going on. Once you start to get measured, you realize that, those companies where everybody says, with a 10x return or a 5x return, and they're put on a pedestal, you realize the journey, even in those companies, was not every single quarter this beautiful picture. Like there are always lumps and bumps in the road. And I think it's an important lens to take as an investor, but also a founder. Like it could look all up and to the right historically, but it may not feel that way in the moment. You kind of have to ride with those bumps in the road. And I'd also say in the moment, you don't always realize that that one decision was the decision that's going to set the company off in XYZ successful direction. It seems so obvious when you're looking historically, but in those actual moments, you're making the best decision you can for a given circumstance. But which of those 25 decisions made the outcome doesn't feel as clear in the moment.
Interesting. And thank you for that. How do founders think about the difference between like venture capital, growth equity, and private equity, and when they're choosing a partner? Is there different end roads and where they should be focused?
Yes, there's very different experiences across those realms. Outside of check size, it's about how much control you want to give up. So seed and growth equity, for the most part, are going to be minority investors. That means they're used to not controlling the business. They don't get to decide when you sell. They own less than 50%. So you have more say as a founder than they do. Once you get to private equity, they're usually buying the whole business or at least majority of the business. And so they have control. So first decision, do you want to give up control in order to, take some chips off the table? The second decision factor, once you decide, hey, I want minority, let's say you want minority, then you're thinking, do I want a seed investor, VC investor, or a Series A? There are Series A, Series B investors that write $15 million checks, and there are seed investors that write $15 million checks, right? So who do you raise from? It depends on what you want from a risk reward profile. So when we come in, we look for 95% chance that we feel like we're not going to lose our money, which means good retention, hasn't raised a lot of capital. That can kind of give you a lot of comfort on your downside. And then we're looking for folks that have 5x plus potential, where we feel like the business can 5x plus. If you don't think big, you're never going to be big. In VC, I'd say for the most part, you're really just focused on like, do you think you can 10, 20x the business? Downside doesn't matter because I'm going to make 50 investments. And so if most of them fail, as long as some of them reach 100x, that's great. For our founders, that lens matters because it's going to influence how your investors behave and what they push you towards. Now, you still have control. It's still your business, still your decision. But who's in your ear and what are they telling you is important. And so understanding what those investors view as a win is critical. And that's going to differ depending on if you're a VC firm versus a growth equity firm.
Very cool. Melanie, is there a time, whether it's happened or it almost happened, where I'm sure it happens all the time, not every business is a billion-dollar business. Not every business is a unicorn, even though those unicorns are not so rare anymore. What do you ever get to a point to say, hey, listen, I know we're going for a home run. I know you're going for $1 billion, but we don't see $1 billion business anymore. Things have changed. We see a $80 million exit, and that's phenomenal. Let's do it. Do you ever have those conversations, and how do they usually go?
Yeah. I'd say usually that conversation is started by the founders. It's pretty rare that we're telling the founders like, hey, this vision isn't there anymore, because the founders are typically the ones driving towards those great outcomes. And if they believe in it, typically these founders are smart, they are focused on the right things. I do strongly believe you don't have to be $1 billion business to be an amazing outcome for both an investment firm and also a founder. If a founder owns 60% of the business and you come in when it's early enough and you sell it at 400 million, you're set for generational wealth from the founder's perspective, and the investor can still make a 3, 5, 6x return, which
Not bad.
for a growth equity firm where you're have a lower loss ratio, that is still an amazing return. And so I actually think that in growth equity, it is easier to have a, sub $1 billion outcome that is still a great outcome for everybody versus in VC where you're swinging for the fences because you have high loss ratios, bunch of companies that go out of business.
Yes.
You need to make up for that with the upside. And so it may be a different story if you ask the same question to somebody who is an earlier stage or VC focused investor.
Speaking of failures, statistically, I think 90% of companies fail or startups fail, usually in years 2 to 7. There's a big drop off, so on and so forth. What does a VC expect to write off?
So VC is going to be different than growth equity. I'll say, we typically see, I'd say our loss ratio is, much lower than a VC firm. A VC firm is probably seeing a 50% loss ratio. Whereas
within how long? Within how long?
Oh, that's a good question. I'm not sure. I'd have to ask our LPs for the numbers on that one.
Okay.
But I think in VC, my guess is you can actually, I don't know. I've heard of companies that have, been written down to 0 and 5 years in, they make a pivot and are an amazing outcome for the VC investors. So I don't know that I could opine on that one.
Okay. How about growth equity?
Yeah, so growth equity on average, we've actually pulled the numbers from some of our LPs have provided numbers on kind of loss ratios. On average, growth equity firms see 25%, 30% loss rates. We typically see about half that. So Volition has a much lower loss rate, I think, than the industry, and top quartile funds will see something similar to that.
So are you saying that 80 to 90% of the money invested should end up being a successful exit?
It depends on the definition of success, but at least getting your money back. Yes. Yeah.
Got it.
On our software team, we actually have never lost money on a software investment.
Wow, that's amazing. Really good. What's your favorite book you'd recommend to either founders, investors, or leaders?
I love the book Humor Seriously. It's all about how people perceive those who make jokes, even if they're terrible jokes, as actually more intellectual and smarter. So it's an interesting book in terms of taking humor and applying it in the boardroom, in work settings. And one, it makes life a little bit easier and more fun, but it's also a great book on how you can present yourself to the world in a positive manner that also increases how folks view you.
Humor is everything. I mean, we've survived 3 recessions by just having humor and just having fun, just smiling and not taking it so serious. Because at the end of the day, we all go home, hopefully, to our beautiful families, and all is well. And we don't have to take business so serious where we're always miserable. We're miserable because we didn't grow. We're miserable because we're losing money. We're miserable because we didn't get our funds. What's the point? So I like that. That's really good.
Yeah.
Melanie, you've done so much educating. Tell the founders that are potentially interested in getting money more about Volition Capital and who should be potentially looking at you guys and as a potential partner.
Yeah. So Volition, we are a growth equity firm that typically comes in when folks are, say, north of 4 million in ARR. And we write checks anywhere from 15 million on the low end to 75, 80 million on the high end. We're typically writing checks in businesses that have strong growth, good retention, and haven't raised a ton of capital. So we tend to focus more on capital efficient businesses where if you've raised 10 million, you've reached about 10 million in ARR. It's soft line in the sand, but more capital efficient businesses. We're patient investors. We're now in our 5th fund. So we've discussed some of the questions people should be asking. We're in our 5th fund. So our LPs have been with us a while. We tend to invest in companies for a bit longer than the industry average. We're almost always minority investors. So that's our muscle memory. We know how to be partners without full control of the business. We partner through, sitting on the board. So we do always take a board seat. And then we provide resources internally that we've built up where we've said, hey, these are usually pain points. No two businesses are alike, but usually you need to build out a broader executive team. Maybe you didn't need an exec that you now do. So we have a recruiting team in-house. We have an operating partners focused on financial strategy, pricing strategy, go-to-market strategy, annual planning, some of these pain points that come across in every business. And so that's kind of how we think about partnering. If founders are interested in chatting with us, I'd say, reach out to me or anybody on the team. My email is Melanie and then the letter N at volitioncapital.com, or you can reach me on LinkedIn, and feel free to reach out. Even if you're not sure if it is a fit, we're always building relationships over time. It's very rare the first conversation is the moment where you're thinking about capital. So we're always happy to provide education and pattern recognition of what we've seen even before it's time to partner as investors.
That's great. And investors, same thing, guys. You want to be part of the fund. I don't know if there is a fund coming up. Hit up Melanie. It's a great. I've had 2 conversations. Been very impressed with their mindset. Speaking of checks, Melanie, how do I go about getting a $15 million check? I'm going straight to the bottom.
Yeah.
I don't need the 80 million. I'm kidding. I'm joking. It was just humor. But if you have
you just have to be,
around,
10 million ARR business, growing at a nice clip.
Without
too much capital raised in a high growth market. It's easy as that.
Well, when we get there, which we were very close, we will be talking. Melanie, You've been great. Thank you for sharing your insights on fundability, investor dynamics, and the patterns you see across growth stage companies. I've learned a ton. Hopefully, the audience as well. Really appreciate you being here. Thank you so much, Melanie.
Thanks so much for your time. It's great to chat.
Absolutely. Thank you so much.
And that brings us to the end of another great episode of the Tech Leaders Playbook. I want to thank you for joining us and hope you took away some valuable insights to apply in your professional journey. Don't forget to subscribe on your preferred podcast platform so you don't miss out on the next great conversation. I promise it'll be good. If you enjoyed today's episode, we'd appreciate if you could leave us a review. Your feedback not only helps us improve, but also help others discover the podcast. Better leaders mean better working environments. Better working environments leads to happier people. Remember, a rising tide lifts all boats. I'm Avetis Antaplyan, and this has been the Tech Leaders Playbook. Keep leading, keep learning, keep giving, and I'll see you on the next one. Until then, stay inspired, my friends.